On January 31st, 2026, a single name triggered one of the largest single-day wealth destructions in financial history. Gold crashed 11% in one day.
Silver had its single worst trading session since 1980.
Bitcoin, which had been sitting at $126,000 just months earlier, got cut nearly in half. And barely anyone in mainstream media connected the dots on WHY. That name? Kevin Warsh. And here's the thing, if you don't know what the Warsh Doctrine means for your money, for your mortgage, for your portfolio, you need to stay right here for the next 17 minutes. Because the Federal Reserve you have known your entire investing life, it no longer exists. Before we talk about the Fed, you need to understand the world Kevin Warsh is about to walk into, because right now that world is genuinely on fire. As of this week, President Trump has issued a hard deadline to Iran. Reopen the Strait of Hormuz by April 6th, or face what he called, and I am quoting directly, extensive attacks on Iranian energy infrastructure. Now, let me be very clear about why that sentence should get every investor's full attention. Roughly 20% of the world's entire oil supply flows through that strait, 20%. And Brent crude has already responded, spiking to $115 a barrel. But it gets worse than that. On April 3rd, just yesterday, Iranian forces shot down a US F-15E fighter jet. A search and rescue mission is currently active for a missing crew member. An A-10 Warthog was also damaged during the rescue attempt.
The International Energy Agency has come out and compared this energy crunch to not one, but two historic shocks at the same time: the 1970s oil crisis and the Ukraine war combined.
We are not operating in a normal economic environment right now. And this is the backdrop against which the next chairman of the Federal Reserve is about to take the stage. Let me be direct with you. Kevin Warsh is not just another new Fed chair. He is not a tweak to the existing playbook. He represents a genuine regime change, a complete philosophical overhaul of the institution that has governed monetary policy since the 2008 financial crisis. To understand the Warsh Doctrine, you first need to understand what he is fundamentally against. For the last 18 years, investors worldwide have operated under a single unspoken assumption. When things go bad, really bad, the Fed will print money and rescue the market. The market has a name for this. It's called the Fed put. The idea that no matter how far assets fall, the Federal Reserve will always be there to catch them.
Kevin Warsh spent his career calling that assumption dangerous.
He has described the Fed's $6.6 trillion balance sheet, which exploded from one crisis response to the next, as, and I quote directly, a proxy for mission creep. He believes that endless money printing hasn't reduced inequality in America, it has actively made it worse. He has also said, loudly and publicly, that he wants the Fed completely out of political and cultural issues. Climate policy, social inclusion agendas, all of it. His vision is a narrow, disciplined, rules-based central bank with exactly one job: price stability. Full stop. But here is where the Warsh Doctrine gets genuinely interesting and genuinely misunderstood. He is not a simple hawk. He is not the kind of central banker who just wants to raise rates and crush the economy to kill inflation. What he's proposing is something more sophisticated, what analysts have started calling a monetary barbell strategy. On one end of the barbell, aggressive quantitative tightening. Rapidly shrink that $6.6 trillion balance sheet. Do it fast. Why? Because that restores what Warsh calls policy space. It means the Fed actually has tools left to fight the next crisis, instead of arriving to the next recession already spent. On the other end of that barbell, short-term rate flexibility. And here is the twist most people miss. Warsh actually believes that if artificial intelligence is genuinely boosting economic productivity, and there's a credible case it is, then short-term rates can come down without triggering a new inflation wave. This is partially why Trump nominated him. There's a path in Warsh's framework where rates fall. But, and this is absolutely critical, the market does not believe that path is open right now. The Warsh Shock told us exactly that. Right now, higher for longer is what has been priced in, and I'm going to show you why.
January 30th, 2026. The White House officially announces Kevin Warsh as the nominee for Federal Reserve Chair.
January 31st, the market has a complete and total meltdown. Let's go asset by asset, because if you were holding any of these positions, you felt this in your account personally. Gold, down 11% in a single trading day. To put that in perspective, gold is supposed to be the safe haven, the asset you run to when everything else is burning. And it fell 11% in 24 hours. Silver crashed 36%. 36%. That was silver's worst single day since 1980. The COMEX exchange saw a wave of forced liquidations as leveraged positions got wiped out in real time. Bitcoin had been riding a euphoric rally all the way to $126,000 in October 2025. By the time the dust settled from the Warsh nomination, it had been cut nearly in half, consolidating below that critical $70,000 psychological level. And 10-year Treasury yields? They hit 5% for the first time since 2008. The yield curve steepened violently. So what actually happened? Why did one single White House announcement trigger all of this across so many completely different asset classes simultaneously? It comes down to something traders call a leverage trap. For years, really, since 2008, investors had been borrowing heavily and piling into assets. Gold, crypto, tech stocks, bonds. All of these positions had one thing in common underneath them: the assumption that the Fed put was permanent. That no matter what happened, the Federal Reserve would print money, buy assets, and rescue the market. When Kevin Warsh, a man whose entire public career has been built on criticizing exactly that policy, got nominated to run the Fed, every one of those leverage bets suddenly had no floor beneath them. The market priced in the death of the Fed, put in real time, every over-leveraged position unwound simultaneously. That is where your $15 trillion went. In one day, gone. So the question on every investor's mind right now is simple. When do rates actually come down? And the answer, backed by four distinct structural forces that are all pointing in the same direction, is probably not before 2027. Let me walk you through each one. In March, before oil hit $115, before the Hormuz Crisis fully escalated, the Federal Reserve already revised its 2026 inflation forecast UP to 2.7%. 2.7, that is above their 2% target, and that was before this week's events. With energy prices surging past $115 a barrel and fertilizer shipments through the Strait of Hormuz being disrupted, food and energy inflation are widely expected to accelerate further through the back half of 2026. Here is the iron rule of central banking. You cannot cut interest rates into accelerating inflation. It would undo every percentage point of the fight since 2022. Warsh knows this. The market knows this. It's that simple. This one gets less airtime, but it may matter more over the long run. The One Big Beautiful Bill Act, and yes, that is the actual official name of this legislation, is projected to add $4.7 trillion to the national debt by 2035. The Congressional Budget Office estimates that the surge in federal borrowing alone will push 10-year Treasury yields up by 0.16 percentage points in 2026. That is what economists call the crowding out effect. The government is competing with private borrowers for the same pool of capital, pushing up the price of that capital for everyone. And here is the cruel irony embedded in this bill. $100 billion in retroactive tax refunds is being pumped directly to consumers in the first half of 2026. Economists are already drawing direct comparisons to the 2021 stimulus checks, the money that created the inflation crisis that the Fed then spent 3 years fighting.
We may be about to deliberately repeat that mistake at a time when inflation is already above target.
Remember the barbell strategy I described earlier? Here is where it becomes a double-edged sword that cuts both ways. Warsh wants to shrink the balance sheet aggressively. At the same time, the Trump administration is loudly pushing for lower short-term rates. Those two things happening simultaneously do something very specific to the yield curve. They put massive upward pressure on long-dated Treasury yields. The 10-year, the 30-year. These are the interest rates that determine your mortgage payment, your car loan, the cost of capital for every business in America. So here is the trap. Even if the Fed technically cuts the headline Fed funds rate, the rates that actually affect your everyday financial life stay high. The plumbing of the financial system tightens regardless of what the press conference says. You get the headline of a rate cut without any of the actual relief. Stanford economist Darrell Duffy put it bluntly, you can't do much unless you reduce the demand for reserves. It's going to be quite a lot of work. Now, none of this exists in a vacuum. The Warsh Shock didn't just move institutional portfolios, it exploded across retail investing communities. And some of the narratives circulating are genuinely worth engaging with because they tell you something real about the psychology driving market behavior right now. The hawkish dove paradox. This is the most substantive debate happening in financial circles right now. Trump nominated Kevin Warsh specifically to cut rates that was the stated objective. But Warsh's entire career as a public economist has been about sound money. His published papers, his Fed governor voting record, his public speeches. All of it points toward tighter, not looser policy. The question being asked not just on Reddit, but by professional macro analysts, is whether Warsh is effectively a Trojan horse. Did the Trump administration get the exact opposite of what it thought it was getting? The dead internet theory applied to finance. This one is darker. Financial forums are seeing a surge in the theory that AI-generated synthetic content is being weaponized to manipulate market sentiment around the Iran conflict, either exaggerating escalation signals to spike energy, futures, or downplaying them to collapse them. The idea that you fundamentally cannot trust what you are reading about a live geopolitical crisis because bots may be manufacturing the narrative. George Lagarius at Forvis Mazars gave the most grounded advice on this. De-escalation is as much on the table as re-escalation. Respond only to verified facts. Write that down. The WSB war machine. On Wall Street bets, something genuinely strange is happening. Retail traders are deliberately buying volatile meme assets not just for profit, but as a deliberate act of protest. Consumer resistance against a financial system they feel has been fundamentally reset to favor institutional players. There is a raw populist anger in the market right now that is feeding volatility in ways that traditional quant models are simply not built to capture. Do not underestimate it. So, what does all of this actually mean if you are a real person trying to navigate your finances in 2026? Not a hedge fund, not a trading desk, just someone trying to make smart decisions with their own money. I am not a financial advisor, and nothing in this video is investment advice. But I can give you the framework for thinking about this environment clearly. 1. Watch the 10-year Treasury yield, not the Fed headline.
Even if you see a press conference announcing a rate cut, check the 10-year yield first. If it's still elevated, the real cost of borrowing hasn't moved for the majority of people.
The headline and the reality can diverge significantly in a yield curve steepener environment like this one. 2. The balance sheet is the real policy signal. Warsh said it himself. The core cause of inflation is excessive liquidity and an abnormally large balance sheet, not interest rates. Watch what the Fed does with its $6.6 trillion in assets. That is the real policy dial, not the rate announcement at the press conference. 3. Geopolitics is now a monetary variable. This is new. The Hormuz crisis is not separate from Fed policy. It feeds directly into the energy inflation data that constrains the Fed's room to maneuver. April 6th is not just a geopolitical deadline. It is a financial event. Watch it accordingly. 4. The confirmation timeline is a volatility trigger. Any significant development in Warsh's Senate confirmation hearing, positive or negative, will move markets. Put the week of April 13th on your calendar, and watch for any DOJ developments on the Powell probe before that. Here is the bottom line. For 18 years, every investor on Earth operated with one unspoken guarantee. The Fed has your back. When things get bad enough, they will print money, buy assets, and restart the cycle. That was the flaw beneath every leveraged position, every risk trade, every buy-the-dip instinct. That flaw is now officially under review. The Warsh Doctrine, whatever final form it ultimately takes, represents a real, documented, philosophical break with the post-2008 playbook. Whether Warsh turns out to be the aggressive hawk his history and writing suggest, or the gradual rate cutter Trump is privately hoping for, the uncertainty itself is already doing damage. Already reshaping asset valuations, already repricing risk. No rate cuts until 2027 is not a dramatic prediction. It is the base case. 4 structural forces, accelerating inflation, fiscal expansion, yield curve steepening, and a political confirmation standoff, are all pointing toward the same conclusion simultaneously. The regime has changed. The question is whether your portfolio knows it yet.
If this video connected the dots for you on what is actually happening in macro right now, hit subscribe. I break down the stories behind the headlines every single week.
And right now, the headlines are moving faster than they have in years. Drop a comment below one question.
Do you think Kevin Warsh is a hawk or a dove? I genuinely want to know where you stand. The debate is real. And if you want to go deeper on any of this, I've linked every key source directly in the description below. Do your own research, verify everything. That's how you win in this environment.